Stop me if you've heard this one before. The ship is taking on water. They're giving all the lifeboats to the wealthy people while the poor folks are locked below decks, and the crew is assuring everybody that this ship can't sink. Well, the ship is our banking system, and the lifeboats are the FDIC's Deposit Insurance Fund. And right now, the FDIC is burning through the Deposit Insurance Fund at an alarming rate while giving all of the financial lifeboats to wealthy, uninsured depositors, people with money above the FDIC's $250,000 limit. With today's failure of First Republic Bank, on top of the prior failures of Silicon Valley Bank and Signature Bank, now the FDIC has burned through 28% of all the money in the Deposit Insurance Fund, and they've used it to bail out people who were not supposed to be insured. Heading over to Bloomberg, dated just this morning, JP Morgan ends First Republic's turmoil after FDIC seizure. The largest U.S. lender is poised to grow even bigger after the deal. Note to self, that's not legal, but they did it anyway. Bad investments and a run on deposits led to the bank's seizure. JP Morgan Chase & Co. agreed to acquire First Republic Bank in a government-led deal for the failed lender, putting to rest one of the biggest troubled banks remaining after turmoil engulfed the industry in March. The transaction, announced in the early morning hours Monday after First Republic was seized by regulators, makes the biggest U.S. bank even larger while minimizing the damage to the Federal Deposit Insurance Corporation's guarantee fund. And folks, that right there is at best an omission and at worst a lie. They're telling us that what they did was to minimize the damage to the Federal Deposit Insurance Corporation's guarantee fund. But that's not true. If they really wanted to minimize the damage to the FDIC's Deposit Insurance Fund, they would not have bailed out the uninsured depositors. You see, the law says that people with balances in excess of $250,000 are not insured. Everything above that $250,000 limit should be converted to equity in the bank in the event of a failure, and in this case, that equity would be worthless. But that's not what they do. They threw out the law, the Dodd-Frank Act, which was passed after the global financial crisis, and they said, instead, we're going to give these lifeboats, we're going to give money from the Deposit Insurance Fund to these wealthy people who are not supposed to be covered. Now, I realize it's the 2020s, and in the era of trillions upon trillions of dollars, it's very easy to forget that money is, in fact, a finite resource, but it's very important here. This money has been set aside in the form of fees charged to customers. You have paid this through transaction fees paid at your bank, and this money, instead of being used to protect you from a bank failure, it's being used to bail out wealthy depositors who these funds were never intended for. And so no, this deal with JP Morgan did not minimize the damage to the FDIC's Deposit Insurance Fund. All it did was minimize the damage to the insurance fund while still guaranteeing that rich people were protected when they were not supposed to be protected in the first place. And this is all thanks to a loophole in the Dodd-Frank Act that City Journal was talking about here back in April 5th of this year, the loophole that sank Dodd-Frank. The more systemically risky a bank is, the easier it becomes to bail out. Though Dodd-Frank tried to limit bailouts by the Federal Reserve, the act kept and clarified the separate systemic risk exception for banks taken over by the FDIC, and thus the government's ability to rescue their creditors. FDIC Chairman Martin Gruenberg confirmed to the Senate last week that he used the Dodd-Frank Act's systemic risk exception to bail out depositors at Silicon Valley Bank and Signature Bank and to facilitate a sale of those two banks at a cost to the taxpayers of about $22.5 billion, or almost $70 for every man, woman, and child in the country. And you can now add First Republic to that list because they use that same exception today, and they estimate that it's going to cost another $13 billion from the Deposit Insurance Fund to rescue First Republic. He also noted that after these bailouts, depositors were moving their money into systemically important banks. Those depositors understand that the systemic risk exception and the rule barring general deposit guarantees move the U.S. banking system closer to a too-big-to-fail standard than ever before. What City Journal is talking about here is this has created a flight of capital from small banks into big banks where they perceive to be less risk. Now, the whole point of Dodd-Frank was to make sure that no bank ever became too big to fail again. Now, here we are 10 years later, and in the span of a month, we've had 3 bank failures, and our regulators have deemed all 3 of them to be systemically important banks, and therefore they've been bailed out using this provision. So apparently, virtually all banks are too big to fail now. Now, I'd also add that Dodd-Frank made it illegal for any bank to take over more than 10% of all deposits in the United States. Here we go in the Treasury's own website. Section 622 of the Dodd-Frank Act establishes a financial sector concentration limit that would prohibit a financial company from merging or consolidating with or acquiring another company if the resulting company's consolidated liabilities would exceed 10% of the aggregate consolidated liabilities of all financial companies. In other words, no bank is allowed to be more than 10% of the market. Well, with the purchase of First Republic Bank today, JP Morgan is now more than 10% of the market. Yet another provision of the law that was supposed to prevent more too-big-to-fail banks has been thrown out the second the going gets tough. Now here's the FDIC's website, and you can see right above my head the deposit insurance fund balance increased by $2.8 billion last year to $128.2 billion. That's all the money that the FDIC has charged your bank, and therefore your bank has charged you in order to guarantee deposits at your bank. Deposits beneath the $250,000 threshold. Those are considered insured deposits. The problem is, after the failure of Silicon Valley and Signature banks, the FDIC drained $22.5 billion of that $128.2 in order to bail out the uninsured depositors at Silicon Valley Bank and Signature Bank. And then today they drained another $13 billion in order to bail out the uninsured depositors at First Republic Bank. That's $35.5 billion, 28% of all of the funds being held in reserve at the FDIC have been burned through in order to protect people that the law never intended to protect. Those lifeboats were meant for everybody on board the ship, not for the rich people and their luggage. And this is why the FDIC is playing with fire here. They're giving away all the money against what the rules say in order to protect their rich buddies. And sooner or later, the FDIC is going to run out of money. And apparently, it's going to be sooner than you think. See, even though the FDIC supposedly has $128.2 billion in their deposit insurance fund as of the end of last year, that fund actually only exists as a line of text on a spreadsheet with the government. What the FDIC actually has access to at the moment is the Treasury General Account, Uncle Sam's checkbook. And right now, Uncle Sam only has $296 billion left in his account. And with the federal government up against the debt ceiling, they can't borrow any more money to make that number go up. So this is the amount of money, $296 billion. This is what the government has to work with until the debt ceiling gets raised. And right now, they're burning through tens of billions of dollars every few weeks just to fund the government, and several tens of billions of dollars more every few weeks to bail out banks and their uninsured depositors. And that's why Janet Yellen here is in the press today saying we could hit the debt ceiling as soon as June 1st and warns Congress to act as soon as possible. Treasury Secretary Janet Yellen notified Congress on Monday that the U.S. is projected to reach its debt limit as early as June 1st if the body does not raise or suspend the debt limit before then. You see that date, the X date as they call it, the day the government runs out of money and can't borrow anymore, it keeps getting closer because the government keeps burning through their cash to bail out banks and uninsured depositors that they shouldn't be bailing out. This day is only going to get closer as banks keep falling. But wait, it gets better. The U.S. plans to borrow $726 billion just during the quarter. That's $449 billion more than they projected just in January, due to lower beginning of quarter cash balance and projections of lower than expected income tax receipts and higher spending, because the government's making less in tax revenue and they're burning through cash faster to bail out these banks they shouldn't be bailing out. The government is set to borrow over $700 billion the moment the debt ceiling gets raised. And even though the FDIC is rapidly running out of money, and even though the Treasury is rapidly running out of money, we got this today. U.S. weighs more business deposit insurance after banks fail. The FDIC announces several options for deposit insurance fund. The agency says increasing coverage for businesses is a good option. They're saying they want to change the laws governing FDIC insurance. Why? They're not even following the laws that they already have. The Federal Deposit Insurance Corp on Monday laid out 3 options for the Bedrock Fund, which currently covers up to $250,000 on most accounts. The regulator highlighted the impact of technological changes and high concentrations of uninsured depositors in pockets of the banking system as reasons for the possible overhaul. Now, here's the sad reality, folks. There's $17.2 trillion worth of deposits in all commercial banks at the United States, shown right here in the St. Louis Fed website. And right now, Janet Yellen and the White House and the FDIC and the Treasury and the Federal Reserve, they're acting like they can insure every single penny of every bank account. They cannot possibly do that. There are not enough lifeboats on this ship for everyone, at least not in its current form. Right now, there's $128.2 billion in the deposit insurance fund, and that is supposedly backstopping $17.2 trillion worth of bank accounts. The numbers just don't add up. The only way to insure all $17.2 trillion of deposits is to dramatically increase the fees that banks are charging to customers in order to pay into the deposit insurance fund. In other words, a tax on your bank account is what the government is proposing because they've already burned through all the money they already taxed from you in order to bail out the rich people who were never supposed to be bailed out with that money to begin with. So the sad reality, folks, is that FDIC insurance is all smoke and mirrors. There's just no way to insure all deposits at all banks in the United States. There's not enough lifeboats on this ship for everyone. And right now, more than a quarter of the lifeboats have already been given out to the rich people who bought their luggage along with them when we could have put more people on those boats. And there's no point in debating changes to the law until Congress and the FDIC and the Treasury and the banks start following the laws that they already wrote. They passed these laws after the global financial crisis to prevent any bank from ever becoming too big to fail again, and they're disregarding those laws at every single turn, bailing out depositors who are not supposed to be bailed out, allowing JP Morgan to get bigger than the law says they're allowed to get, and now they want to change the law to charge you more in order to make sure they can bail out more rich people, in order to make sure more of the wealthy passengers can bring their luggage on the lifeboats, even as the boat goes down. But you know what? What do I know? I'm just a perma-bear YouTuber who's stirring people up into a panic over nothing. I should just shut my mouth. Our banking system is safe and resilient, right?
The American banking system is really safe and well capitalized.
So this is the ship they say is unsinkable.
Americans can have confidence that the banking system is safe.
It is unsinkable. God himself could not sink this ship.
And I think depositors should assume that their deposits are safe.
But this ship can't sink.
She's made of iron, sir. I assure you, she can't.
Till next time, live small and dream big.